The simple objective divergence trading strategy. Now, we've already showed this a couple of times earlier here in the course. Now we're going to really go over the details for the rules. Now, if you've been around Forex Mentor for a while, you've probably seen this strategy traded in one form or another. I've taught it for quite a while myself here at Forex Mentor. All right, so now we'll get into the details and the rules as I'm going to teach it. Now, this is our simple objective method for entering into divergence trades. The very first thing we want to do is make sure price has moved into a key level of support or resistance where the divergence is occurring. This pretty much goes for any strategy we're going to trade. Next, we want to see a sharp price move to break the high or the low point between the points that diverged. And this is where I may differ from some others. Okay, we want to see that sharp price move. We want it to be one cycle. Okay, and we want it to break the high or the low between the points that diverged. After the break of the high or the low, we wait for a corrective pullback 50 to 62% for our entry. Some of our members like the 79% fib level because it offers a better reward to risk. If you're trading from the 62% and targeting the 127, normally that works out to about 2 to 1. The 50%, not going to quite be 2 to 1. It's best to have a limit order waiting since the market can move fast at times. It can get pretty volatile, so it's better to have a limit order waiting. Now, our target is going to be the 127% or the 162% Fibonacci extension. You want to make sure you choose your target before your entry based on a solid technical reason. Now, the only time we're really going to trade the 162 or target the 162 is if we have a reason on the higher degree time frames to look for a larger move. Then we want to reduce or remove risk when price retests that higher low point that was broken to qualify the setup. Now, this is also where I may differ a little bit, and I say reduce or remove because we want to make sure our stop stays protected. So sometimes it's better to move the stop just below the swing point. Normally there's a swing point created at the 62% or the 50%, wherever price turns to go retest that higher low point. Normally we see a swing point develop there. And that's a good place to protect your stop loss. Okay, so maybe you might have 5 pips left in the trade of risk, but who cares? It's better to have that stop protected. Now, just a quick side note, as far as the sharp price move, where we said we want it to be one cycle. The only exception to that is if we have an extension. I'm going to explain what that is here shortly. So let's go ahead and look at some examples here of this divergence, the simple objective divergence trading strategy. I know it's a mouthful there. All right, so let me go ahead and pull up a chart. Okay, here's our Australian dollar, US dollar. This is a 15-minute chart, and we're going to assume that we are at a level of resistance here. Okay, because I don't have the ability to actually go back and show the level, but we have price moving higher. MACD is cycling lower here. Okay, we have a sharp price decline that breaks through this low point. All right, so when you see me qualify a divergence setup on our chart, you're going to see this a lot. You'll see me draw the divergence, and you'll see me draw the point where it qualifies. All right, so here's a sharp move. Now we're measuring the corrective setback. All right, so we want to draw from our high to our low point, and you can see my divergence tool here that I have the template for my Fibonacci retracements already has the extensions. So you can see price pulled back to the 50%. Now at this point, when price declines and we test this low, okay, so just to draw this in, once we decline and we test this low, that's when we want to reduce or remove the risk. Okay, and in this case, our stop loss on the initial trade, and we'll just draw that in here as well, our stop loss goes above the high. Okay, so when we enter into the market, we place our limit order to 50 to 62%. Some folks like the 79%. So when the market moved back to 50%, if you had your order in to 50%, it would have triggered that order. Now we came down to test the low. So at that point, we want to take the stop loss and move it just above that swing point. Okay, so we still have a few pips of risk in the trade, but our stop is protected behind that swing point. Okay, and in this case, you can see the market didn't pull back very far. This is normal to see price react around this level, so don't panic. Okay, it's normal to see price react around support. We get a little bit of a pullback, and then we continue down to the 127. Okay, now in this case, you can see the price rallied a bit again, and then came down close to that 162% target. Or I should say the 162% extension. That wasn't our target. Our target was the 127. But you can see how the market reacts to these levels. Right after this, you can see we actually ended with a divergence. Okay, price moving lower, MACD cycling higher here, and we had an extension. After this extension, however, the market failed to pull back very deeply. Here is a 5-minute chart where we can see we have price moving lower. MACD here is cycling higher. Sorry about that, I had to get past those little buttons. MACD is cycling higher. We have price breaking the high point, okay, between the points that diverge. So we have price rally up in a sharp cycle. And then we look for our pullback, 50 to 62%. So here you can see the market pulled back 62%, rallied right to the 127%, found some resistance, and then continued on to the 162%. And that's again where we found some resistance before pulling back here. Here's another example of price moving lower, MACD cycling higher. We had a nice sharp move here to break the high point right here between the points that diverged. And then on the entry, see the market here pulled back to the 50 or 62%, probably even the 79% in this case, even to the 79%. Then we started to rally. We never tested that high. We did have price pullback, and this is why it's important to keep your stop protected. Okay, our stop, remember, is below the low. Below the low. So we're fine with that. The market never moved back below that low point, below that swing point. We rallied up. At this point, we would have taken the risk here out of the trade at this retest, or at least reduced the risk at that point. And you can see the market rallied up to the 127. 127 is where we found resistance, and we had a pretty sharp sell-off here. Now obviously this was an hourly chart, so this trade took quite a bit of time to play out here. Now this example is of what we call an extension setup, and we'll talk about the extension setup here. You see how we didn't have a sharp movement to break the high. Okay, first of all, let's go ahead and draw this in. Price moving lower, MACD cycling higher. Now we had a rally. Let me use the other tool here. We had a rally, a pullback, and then another rally. Now we know that a corrective cycle will often target the higher low between the divergence points. Okay, so we don't want to trade this type of a setup if it just breaks this high. We will trade this, however, if it creates an extension. Okay, this starts to get into what we call the extension setup, because we use this in other situations as well. The extension setup is when we can measure from this, which is basically our A wave, down to the bottom of our B wave, and the C wave, or a 3, this could be a 1, 2, 3 also, extends to the 162% Fibonacci projection. Okay, this is the projection or expansion tool, so make sure we're measuring from the high to the low to project that out. Right, in this situation, we'll qualify this setup. So we will look to buy the pullback here. So we've measured now from our low to our high, and we would get our entry level 50 to 62%. And now you can see the target of 127%. After price rallied right here, we would have went ahead and moved the stop loss. And remember, we put our stop loss just below the low of the pattern here. After price, this is our entry zone. Once price rallies to test the high, all right, we go ahead and move the stop to just below the swing point. Again, if you want to remove the risk, you can. I like to keep the stop protected behind the swing point. We had a little bit of a pullback here. Remember, when we test this resistance level, a lot of times we'll get some pullback. All right, we did here, and then price rallied back to the 127 to the profit target. Okay, but what made this a qualified setup, even though this was a three-wave pattern and not a sharp rally to break the high, was this extension. Everything else we handled the same. Okay, folks, that is the simple objective divergence trading strategy. And this is something we're going to show a lot of examples of, especially in the follow-up service.